Hello there and welcome to Project Business Basics, designed to give some information about how financial markets work and various accounting practices in order to give you the tools to make smarter financial decisions. Whether you're looking to learn something brand new or just want a refresher on some basic economics, there's a place for everyone on our podcast. I'm Archit Janarkar and I'm your host. Today we're going to be looking at fundamental analysis, and there are two main ways to look at investing. There's fundamental analysis, which is evaluating if a company is a good investment and looking at stocks as investing into businesses. And then there's technical analysis, which statistically analyzes stock price movements and looks to gauge human behavior in the stock market in order to make winning stock picks. And generally, when looking at them, fundamental analysis is over a longer period of time for investors with a longer time horizon, and technical analysis is in the short term. And we're going to cover both fundamental analysis and technical analysis at Project Business Basics, but they're both so in-depth that today we're only going to be able to cover fundamental analysis. An expanded definition of fundamental analysis. What does it look for? Well, fundamental analysis involves looking at all the aspects of a company. It evaluates geopolitical, economic, financial factors, past financial performance, and the future outlook of a company, along with that of its competitors. And like I mentioned, it's for a long-term investing horizon where you're not worried about the price fluctuations of the daily market or just even for the month. You're looking at it for not even a year, but 3, 5, 10, even longer period of time. So what might fundamental analysis look like in action? Well, to do that, today what we're going to do is take a company, Netflix, with the stock ticker NFLX, and we're going to ask ourselves some questions regarding factors that a fundamental analysis investor might look at whenever deciding to invest in a company like Netflix. And this is to give you an idea of what fundamental analysis encompasses and what fundamental analysis looks for when deciding to invest in a company. So, overall, you want to start off by asking yourself these questions. And what you're trying to get at is you want to understand the business model of the company. How does the company make money? What costs does the company have? What are the risk factors involved in investing in the company? How big of a market share does the company have? And is the market for this company's products fixed size or variable? Where the company's market that they cater to, is it growing or is it going to remain the same? Our first question in regards to Netflix. How does Netflix make money? Well, Netflix, charges users for a monthly subscription fee to watch movies and television. That's their primary way of making money. They have I think it's 3 different plans that a user can sign up for. And now, what costs does Netflix face? Well, Netflix has 3 primary costs. One is paying the owners of the movie and television shows that they have on their platform. For example, Sony Pictures is a company that makes a lot of movies and is also starting to produce television. And Sony has the rights to a lot of classic movies, a lot of famous movies, and Netflix would obviously like to have the best content on their platform in order to entice more users to come to Netflix. So if Netflix wants to have that content on their platform, then what Netflix has to do is then pay a company like Sony in order to be able to show Sony's movies and Sony's films on Netflix's platform. Then the second cost Netflix might face is salaries, and this is something that pretty much every single company out there does. And unlike a company like Uber, for example, Netflix's workforce is limited to pretty much the people who are either making movies for Netflix curated content or the people who are building the Netflix system and doing the programming behind it, and Netflix executives. And then the third cost, which I kind of alluded to before, are costs associated with filming Netflix curated content. Because Netflix, if you've noticed over the past few years, what they've been doing is they've been getting a lot of famous filmmakers. For example, this past year, they released a movie with Martin Scorsese called The Irishman, and Netflix put a lot of money into this movie. And the reason why they're doing it is because their competitors, like Disney or NBC, which before would happily loan Netflix shows like The Office or Friends or the Star Wars movies without thinking, they would loan their content to Netflix. And at the time, they didn't think too much of it. But then as Netflix started taking off, these companies started noticing, hey, maybe there's a way for us to make money without us loaning this to Netflix. So they took their content off of Netflix. So then Netflix is left with the question of, well, now that the best content is being taken off of our platform, how do we entice our users to stay and not leave for our competitors? And so you've been noticing Netflix start to get people like Martin Scorsese. They've started partnering with him to make films. You've seen them, if you're a movie fan, you've seen them make runs at the Oscars the last 2 years with Roma, The Irishman, and Marriage Story. So, what are possible risk factors associated with Netflix? Well, first is competition. We've seen Amazon, Hulu, Disney, NBC, and HBO. They all either have their own streaming services or all are opening their own streaming services within the next year. And we've seen this happen just within the last year. Amazon and Hulu have long had their own platforms, Amazon with Amazon Prime Video. But Disney recently launched Disney Plus, I think it was in November, and they've really gotten some good numbers from there. And then HBO had a little fiasco with theirs regarding calling their platform HBO Now, HBO Go, and there was a bit of confusion over that. But the point is that all five of these companies are direct competitors with Netflix, and they all five have really great franchises, really great movie partnerships and television partnerships that are making a lot of money for these companies. So it's a pretty tight race regarding Netflix. And that leads us to the second risk factor associated with Netflix, which is Netflix's streams of income. I mentioned before that pretty much the only way that Netflix really makes money is through their monthly subscription fees. And that's not something you really see with much of its other competitors. The only competitor that we've mentioned that has the same problem like Netflix is Hulu. Otherwise, Amazon makes money through its e-commerce mainly. Disney with its parks and its movies that it releases in theaters. NBC also has a lot of other platforms that it owns. The same goes for HBO. Those other companies pretty much make money besides just the streaming service that they're opening up or have opened up. Netflix is solely reliant on that streaming service, meaning if, let's say, Disney continues its upward movement and manages to take Netflix's user base from it, then you're looking at a company that's been hollowed out because it doesn't have any other way of making money. Now let's look at Netflix's current market share. Netflix is pretty amazingly used by 37% of internet users, which is about 183 million users around the entire world. And this next statistic that I'm going to list was taken before Disney Plus was released, but approximately 85% of US households that used video streaming used Netflix. And that's pretty amazing when you think about it. Netflix was by and large the dominant player and still is the dominant player in streaming service. It's just that you've seen other companies, Disney, NBC, HBO, really try to chip away at that base and finding some success. So we'll see where that goes in the future. And now let's look at, is Netflix's market fixed or variable? And the good thing is that Netflix's market is variable because there are lots of American households that don't have a streaming subscription. So Netflix is really going to want to target those households and get them to join Netflix over their competitors and also hone in on and make sure that their user base stays with them. Another area that Netflix can grow to is outside the United States. Because the United States is its main user base, it's where Netflix was founded, it doesn't have a whole lot of traction outside of the US. And the same can be said for its competitors with Disney, NBC, and HBO, and Amazon, that international markets are pretty untapped regarding streaming services. So When you start to see these companies look for growth outside the United States, then you could really start to see a lot of growth in the entire market that's willing to do streaming services. Now let's look at the statistic called return on equity. Return on equity could tell us various number of things. For example, are Netflix earnings from Netflix created movies enough compared to the cost to make them? For example, I mentioned The Irishman before, and with The Irishman, this became quite well known for them using this de-aging technology to get older actors like Robert De Niro, Joe Pesci, and Al Pacino to look a lot younger than those three actors currently are. And the thing with using de-aging technology is it's extremely expensive. There are lots of costs associated with making movies like that Netflix has to face. And what we're looking at is, are those costs worth it for Netflix? Are they getting good enough revenue or good enough sales with that? So return on equity is equal to the net income that Netflix gets over the shareholders' equity. So with the Netflix curated content that we were looking at before, we might be asking, are they making enough money from Netflix curated movies compared to the amount of equity that they've invested into making Netflix curated content? Next, we can look at a dividend. And what we're trying to look at is, first of all, does the company have a dividend? And if it does, is it making sense for the company to pay the dividend? Is the dividend consistent or is it growing? And finally, does it even make sense for the company to pay the dividend? So let's look at the first question. Does Netflix even pay a dividend? And the answer, in fact, is no. Netflix is a company that does not pay a dividend. But for the purpose of going through this fundamental analysis exercise, let's say that Netflix did pay a dividend. Then we might ask ourselves questions like, are the rest of Netflix's finances strong enough to allow it to spend profits on dividends? Does it make sense for Netflix to be spending money on dividends, or should it be spending money on other parts of Netflix's business? Maybe in getting more high profile filmmakers to create content with Netflix. And then another question we could ask ourselves, has Netflix's dividend been consistently increasing? If the answer to this question was yes, then this would suggest that the company is a growth company and that it's committed to its investors, it's rewarding investors. And if you're someone who's looking for good dividend income, if you're a dividend investor, then this could be, then an answer yes to that question could be a good sign. And something to look at when investing in all companies using fundamental analysis is this calculation called dividend yield. And dividend yield is equal to the annual dividend per share that a company pays over the company's current stock price. Next, we might look at earnings per share. And earnings per share sounds exactly like what it is. The company's total earnings divided by the number of outstanding shares that are there. And Netflix's 2019 earnings per share calculation for reference was $4.13. That means for however many shares that Netflix has of the company, it earned $4.13 for every one of those shares. So let's, for theoretical purposes, say that they had 1 million shares outstanding. That meant that their total earnings in 2019 would have been $4.13 million. And obviously Netflix has a lot more than 1 million outstanding shares. They have earnings in the billions. So that was just a number as used as an example. But as an investor, you're going to generally want to look for companies with a high earnings per share ratio. Because the higher the ratio, that means the higher their earnings are. Another calculation to be aware of is the PE ratio. And PE ratio stands for price to earnings ratio. And that's asking, what is Netflix's stock price compared to its earnings per share? And PE ratio is equal to the current stock price of Netflix divided by its earnings per share. So Netflix right now has a current 12-month average of about 91 PE ratio. That means its stock price that it's at, I think it's at around 430-ish, but don't quote me on that. That is about 91-ish times its earnings per share. And then finally, another calculation you as an investor might want to look at is the debt to equity ratio. The debt to equity ratio is a comparison of money raised from debt versus equity. Now, debt, as we know, is, for example, a company getting a loan from a bank or through the sale of bonds. That is debt. And equity is basically investments, people putting their money in return for a portion of the company. A factor to look at is the debt to equity ratio, which tells you the total debt in comparison to the amount of equity that the company has. And generally, but not always, investors will want to look for companies with a lower debt to equity ratio. And the reason why that is because debt is generally required to be paid off first. And the more debt that a company has, that means that the more money that a company will have to pay off to debt rather than rewarding their shareholders in terms of dividends as such. So now that I have all these numbers and ratios and I answered all these questions of Netflix's business model, how do I know whether these numbers mean that the company is a good business? Well, the answer to that is to compare those numbers to their competitors. For example, we talked about the earnings per share and price to earnings ratio before. And now I got numbers of $4.13 and 91. Now, by themselves, those numbers don't tell me anything. Is 91 good? Is 91 bad? Or is it mediocre? Is $4.13 pretty good or not? And the way I can figure out or get a sense of whether or not that suggests these numbers are good is by looking at competitors. Try and find out what is Amazon's PE ratio based solely on its Amazon Prime Video business, or its earnings per share from Amazon Prime Video. The same goes for Disney with Disney Plus, NBC, and HBO, and Hulu. Now, if you're a value investor, then you might want to start looking at ways to calculate the intrinsic value of a company. And intrinsic value is the value that you think a company is worth. So you try to calculate what you think Netflix's value is worth based on all these questions and numbers you've answered. If you're looking to try and find even more guidance on fundamental analysis and what exactly you want to look for in a company, or if you're not sure what type of investor you want to be, then a book that I would highly recommend for this topic is the book Common Stocks and Uncommon Profits by Philip Fisher. That book is phenomenal in the way it lays out what you should be looking for investing, and even if you don't agree with it, it gives you an idea of what you could be looking for. And if you're looking for other books that you want to read related to investing, business, self-improvement techniques, accounting, then I invite you to check out our website and look at our blog, businessbasics.online/blog, where you'll find a whole array of book reviews, and you'll also find our newsletter, and as well as our Instagram and Twitter at the businessbasics.online website. If you have any thoughts then about fundamental analysis, or you have any suggestions about any future episodes, then I invite you to reach out to us via social media on Instagram and Twitter. That way you can communicate with us and also get updates on Business Basics. If you like this video, make sure to hit the subscribe button and also leave a like for us. I'm Archit Janarkar. This is Project Business Basics. Thanks for listening.